Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Apple. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsey. Well, I have the chart of the S&P 500 index up. And for the first time in a while, it's actually looking a little bit more negative than it has previously. So last week, we talked a little bit about maybe breaking out above this channel here. Even though we were doing it trepidatiously, we basically had a breakout and fail. So now we're back in the middle of the channel. We broke below the 20-day moving average for the first time in a while. So the chart is looking as bearish as it has in quite some time. But then again, we are in September. What do you see going on this week in the markets?
Yeah, like we've been talking about, September is always the worst performing month of the year. But looking at that chart, you're making a good point. We've been looking at that channel, but we've also been looking at that 50-day moving average, which is the red line there that you're pointing to. And the index is getting uncomfortably close to that level again. It has been really a concrete support for the S&P 500 all year long. The 500 has tested this area at least 9 times so far this year. It looks like we're getting ready to test it again with today's move lower or in the next couple of days potentially, because the month of September has been pretty weak so far. So we're going to be keeping our eye also on that line and that as an indicator of where the market could go from here. But again, the S&P 500 or the 50-day moving average has been a level of support for the index, and we wrote about it on our Community Hub blog, which is at ally.com /do-it-right. So check it out whenever you can. It's under my name, Lindsey Bell. So we talked about the 50-day moving average. Now, looking at the market's move today, the big news is inflation. CPI came out today. It was better than expected. The initial move by the market was higher on that data because it was basically a confirmation of what many market participants expected, and that was that inflation was cooling. So it's still high by historical standards, up 4% on a year-over-year basis. If you look at the core inflation number, which excludes food and energy costs, and that's what a lot of economists look at. That's what the Fed will look at, although the PCE inflation indicator really is the Fed's favorite indicator. But CPI is what we got today, moving in the right direction. And I think, Brian, it really was kind of like a sell the news type of event, even though we got the initial pop on the positive news. In the chart that we just looked at, you see the S&P 500 has been moving higher over the last several months. So the question is, has this been priced into the market already that inflation, in fact, is going to be transitory? Well, I don't think the jury is out yet on confirming if inflation is transitory or not. But today's report was a move in the right direction, like I said, and you did see some positive moves in parts of the inflation reading that are a positive indicator that things could be transitory. So shelter costs were moderating, used car prices, which had spiked significantly with different semiconductor shortages impacting new car sales and used car sales going through the roof because of increased demand. That's starting to come down, moderating too. So those are two key areas that we watch when we're looking at the inflation report. But we also saw demand come down in areas like airline fares or hotel costs. Those were coming down as the rise of Delta caused demand to step back. So prices kind of got pushed lower because of that. And so we're still out for debate on if inflation is transitory or not. The other areas that I'm looking at with regards to where inflation goes from here is some of the China export data. We saw that start to tick up in the month of August. So that's positive. Also, CapEx spending around the globe has increased significantly in reaction to these supply chain constraints that we've had. But ultimately, I think one thing that we know for sure is that labor shortages and wage increases, as well as supply chain constraints, that's going to impact inflation in the coming months. So let's keep an eye on this data going forward. The market's pulling back in a sell the news type of event later this week. We're going to get more news about the health of the U.S. economy, the health of the consumer. We get retail sales on Thursday. And then on Friday, we get consumer sentiment, which we saw drop pretty sharply in the last monthly reading. We'll see if that was just kind of a one-time impact, emotional impact, if you want to say that, related to potentially the rise of the Delta variant, people getting a little more nervous as the Delta situation starts to improve. We'll see if that's changed the consumer outlook at all. And then obviously, Brian, the Fed, next week, we're going to hear from the Fed too. And, tapering is always on the table. And most investors are still wondering what the heck's going to go on with that. So when you see the move in the VIX, you think, oh, that's what is being taken into consideration, Brian?
Yeah, well, what the heck is going to go on? That's the ultimate question. If I look at the VIX, the VIX had a spike up. Obviously, we had some strong down days last week, so we did see the VIX spike up, which usually will happen. But it just shows that the nervousness of the marketplace, ever since the pandemic was announced, even though we're well over a year past the initial downturn in the marketplace, we still see that VIX just not subsiding, not going away. We set new highs in the index and the VIX still stays elevated. Right now, we're showing it at 1886. I'm highlighting that in my VIX watch list. But more important to me is I run out to December and I see that December, not only did it spike up on the downturns, but it's still hanging right where it spiked to, right? The December contract, which this is the futures contract that tracks the VIX that expires in December, those option contracts do, and that spiked up to 23%. So I'm going to go all the way back on my VIX chart. We've highlighted this line quite a bit. This is the line in the sand, if you will. Many times we touched this 20% level and just couldn't break through it until we finally did this April, and now we've been flirting with that 20% level. So yeah, we did, and I'm going to zoom in a little bit here, and you see that we did have that spike up above that 20% level, just kind of showing that nervousness once that marketplace had just the smallest of downturns, right? We once again tried to break out and we failed. Now we're sitting back in the middle of the channel. See the VIX just kind of hanging around this level, but the futures are staying elevated along with the actual spot or VIX index overall. So with that said, we're going to look at Apple today, and I want to talk a little bit about the Apple chart before I pass it over to Lindsey. And this is more of a protective situation.
Before you do that, Brian, I just want to jump in and remind everyone, we've got the chat box open on the right-hand side of the screen. Give us a wave. Hello, we're glad you're here. We love hearing from you. So give us a shout out in the chat box there. And also we'll take your questions at the end of the show. So while Brian starts with the chart and I go through the fundamentals and then he does the options strategy, feel free to ask us any questions and we'll get to as many as we can. Go for it, Brian.
Excellent. And so like if I do look at Apple and I look at the chart, we know that Apple within Ally Invest is one of the most popular stocks. It's widely held throughout our client base overall. And if you look at the chart today, they have a big event, and I'm sure Lindsey's going to talk a little bit about the big event Apple likes to hype. So that's going to be happening actually right after our video today. They'll be kicking off at 1 p.m. Eastern time. But I'm going to highlight this trend line that I have drawn. This is going all the way back to March 23rd. And if we come up, we just do a little touch right here. This is just an interesting area for Apple. And, as far as charts are concerned, I always like to just kind of note what's going on. It's not always a basis of why we do everything here on the stock play of the day. But look right around this area, we see that that's where that trend line is at. We had a lot of activity in this little range. We almost came up and touched it. So right around that 140 range, we did break below the 20-day moving average. We still got the 50-day in there, but there's a lot to be nervous about a little bit, considering the bigger run up that we've had in Apple. Obviously, we've had some news, if you've been watching the news on Apple, that there's been a couple of court filings that have came in based off of their app store and the potential to be a monopolistic in the way that they run their app store. Now that's just one battle. The war isn't even close, but that kind of brought the stock back down a little bit. And once again, we're trading right in this range where you're just a little bit nervous, not to mention we're in September. And just overall, if I'm thinking about stocks that have had good have had a good run so far this year, you just want to think about, well, what are some things that I can do going into the end of the year to maybe try to bring in some income above and beyond dividends, and also look at how we can maybe protect those positions. So with that said, I'm going to pass it off to Lindsey and talk a little bit about what's going on in Apple this week.
Thanks, Brian. Yeah, Brian mentioned today is their fall product launch. So at 1 o'clock, I believe that kicks off. They're actually calling the event California Streaming. Very interesting, catchy little title there. And the expectations that they're going to introduce their new iPhone, a new watch, new form of AirPods. But the expectation is also that it's not going to be all that exciting. It's just kind of a little bit of an upgrade from what we saw in the 12, which, remember, the 12 launch included the introduction of 5G into the phone lineup. So everybody's going to be watching that very closely. I think the key question is, more than what the new features are, is what's pricing going to be. Analysts, Wall Street kind of is wondering if there's going to be a price increase because of the increase of component costs that they've endured, plus some of the new features, which includes additional storage. Are they going to be able to charge more for that, help to offset some of the cost increases that they are enduring, in either maintain their margins, potentially, widen the margins? I don't think there's like this massive expectation that they're going to get a big tailwind from it, but people are going to watch it, and that's one of the questions. But as Brian said, when we look at the chart, this stock has come in a bit just in the matter of really a week. It hit a 52-week high last Tuesday on September 9th. And since then, it's about 5% lower. So it has been an interesting move. A lot of that move, again, related to the federal judge ruling about the App Store, saying that developers don't have to use the Apple App Store for in-app purchases. They don't have to go through there. Apple charges a pretty hefty fee if they do that. And in fact, there's some estimates out there that Apple's revenue from the App Store was about $22 billion in calendar year 2020. So that's about, estimates out there, that's about 7% of sales. Now, many Wall Street analysts, after analyzing the ruling and thinking through it, they're kind of in this position, well, we don't think it's going to be that much of an impact because we expect developers to still continue to use the store, probably because it's a more seamless way to do it, right? And so they're expecting the impact to top line growth to be only about 2%, potentially 4% impact to the profits. So that's what's going on there. Then also yesterday, there was a spyware flaw news that broke, and that also weighed on the stock. So allegedly, hackers can access devices through iMessage without any user action. So Apple's addressing that, and we'll hopefully get that situation ironed out very quickly. They obviously take cybersecurity very seriously. So that is also weighing on the stock. Now, again, when we think about the event that's happening today, thinking about its historical stock price reaction, it hasn't been great. The last two events, so the introduction of iPhone 12 last fall, and then their spring launch this past April, saw the stock fall 2.7% back in the fall, 1.3% the day of the event back in April of this year. So you might see sell the news again type of event in Apple, like what we're seeing in the market today. We're not really sure. I will say though, you know me, Brian, got to take a look at the valuation of a stock. And if I'm looking at the PE ratio of Apple, it has come in believe it or not, most analysts would say 27 times on a forward PE multiple for this stock is high. Well, yeah, it's high by historical standards as they get more into the service revenue that has higher margin potential, and they expand into other areas outside of just focusing solely on the products. But if you think about it, the 7 months going into February of this year, so from about August of last year into February of this year, this stock traded between 30 and 35 times. It spent the majority of the time in that range, which is really high. So we've come in from there, still a little bit elevated on a historical basis. But again, this is a high quality company, and we've seen the market really lean towards investing in companies that are growth at a reasonable price, and Apple could be falling into that territory. Brian, so what do you do? Like you said, a lot of our customers at Ally Invest own Apple, and a lot of people, you probably own it in your 401k. You probably own it if you don't know you own it. If you have 401k. So it's things like that. A stock like this, it's interesting to keep an eye on because it is very widely held, which makes it very liquid, which makes it a good option candidate, right, Brian?
Yeah, of course, we want liquidity. Liquidity means tighter markets, and that's always a better thing overall. So what I'm going to talk about is strategies that will enhance a stock portfolio. So we're going to assume either you own Apple or you're willing to buy 100 shares of Apple. And I'm going to look at a few strategies. I'm going to highlight them in the options playbook right now. The first strategy that I would look at, if I was bullish but nervous, and that's the way that I'm going to kind of approach the theme today, is a covered call strategy. And this is the least protective of the strategies that I'm going to look at today. And I'm going to look at three of them. I'm going to talk a little bit about them, but I'm going to be bringing in some income above and beyond any dividends that will give me a small pillow to land on if Apple were to go down. We've already seen a fairly decent move to the downside recently, about 3% or so. So if we're looking at this underlying stock and we want to sell a covered call against it, not a bad way to look at your portfolio in general. I have 100 shares of Apple. I've had a good run up. I wouldn't mind. I think that things have stalled a little bit in the marketplace, or I wouldn't mind selling if the stock went higher. That's what the covered call strategy is all about. You sell it, you say, I'm willing to give up my stock at a certain price, and that price would be called the strike price overall. Now, another way, if you're a little bit more bearish overall, but still bullish, is a protective put strategy. And we're going to look at both of these when we get to the Ally Invest option chains. But the protective put means that I'm going to draw a line in the sand. I'm going to buy an option contract. I'm going to pay for it. I'm not going to sell it. I'm going to buy it and pay for it. And then I'll have that right to put stock to somebody at a specific price overall. And then the last strategy that we might bring up if we don't run out of time is just look at a collar strategy. The collar actually just combines the two. Buying protection on stocks, buying insurance products on the downside to protect yourself is expensive. So why not sell the call, give away some upside, some opportunity, and use those proceeds to buy a put or protect that position. Now, I'm going to emphasize once again, we're assuming you own 100 shares of stock or you're willing to buy 100 shares of stock. Now, all this being said, nothing on the stock play of the day is meant to be a recommendation. All these strategies that we're talking about right now is I'm bullish but nervous on this scenario. So let's get to the Ally Invest option chains. And I'm only going to go out a few weeks in time. Now, I'm just going to keep it simple. As I said, this is just meant to be a learning situation here on the stock play of the day. So we're going to go out 17 days. It's going to get us through the product launch today. It's going to get us through most of September and partly through October, which have a tendency to be a little bit more volatile months. See if the markets are coming back. We talked about the S&P 500 index looking a little weak on the chart, and some of the other sectors that have been pulling the market higher overall. Russell 2000 index even has came down a little bit and is now trading in the middle of its channel. Okay, so with that said, one of the things you want to note is that earnings are in November. So I always would want to, I don't really want to be in a covered call position going into earnings. I don't like, you do get a bump up in implied volatility. So the options usually become a little bit more expensive. And if you're selling it, that's a good thing. You want to sell it for higher prices than lower prices. But I don't like the volatility that comes along with earnings. So I'm going to definitely avoid that if I'm thinking about selling a call overall. So we're going to go out 17 days in time. We got stock. Well, it's actually down a little bit since we started the call. It's 149.38. It was 150 just a few seconds ago. With that said, we're going to sell something about 3% higher. So we can go out 17 days. We're trading at about a 24% implied volatility, which is average for Apple overall. And we're going to sell, if anything, maybe a little bit on a 30-day basis, a little bit on the low side. But we're going to sell the 155 strike call. So if I sell this call option, I'm saying I'm willing to sell my stock at 155 if the stock gets up to that level within the next 17 days. With that said, I'm going to bring in $1.16 if I just hit the bid. As Lindsey mentioned, this is a very liquid underlying, so it's only got a penny wide spread, 116 by 117. And I can bring in on my 100 shares, I can bring in $116 less commission on that trade. Now, if I don't want to sell the underlying overall, I'm going to have to make note of that. And I do have a section inside the options playbook, and I'm going to run to it right now, called managing your positions. So if I click on that, rolling a covered call is one way to manage. And so if you are in a situation where I sell this call and I might not want to sell my stock overall, you might want to read this. This would be your homework. Rolling a covered call, how to try to avoid assignment, to try. You're not in control when you're selling that call overall. So I want to emphasize try. And then let's come back and say, okay, well, the covered call obligates me to sell that stock at a higher price. What about the protected put? So if we go run back to the change, I would do very similar. We're going five points higher, or about 3% higher. Let's look at about 5% lower. So if I sell this call, I bring in, it's 116 by 118 right now. Or I could go and I'm going to remove this. I'm going to clear this and I'm going to buy this put. So this would be the protected put. Now, in this instance, I am protecting myself against the downside. So as I mentioned, concept would be that you have 100 shares of stock. I'm going to go 5 points down and say, okay, if it goes down to 145, we talked about the 141 area or the 140 area, just a little bit of nervousness. If the stock did start breaking to the downside, that would be an area where you hopefully get some support in the marketplace. But overall, now I'm paying that 158 or $158 on this trade. So you can think of this as a protective trade. I'm taking the first 5 points of risk from 150 basically down to 145. But I'm also, insurance isn't free, right? My protection isn't free. So I'm going to pay $1.56 for that plus commission. That would make my overall risk over the next 17 days, it would be that $5 plus that $1.56. So it would be $6.56 over the next 17 days. That's the maximum that I can lose on this trade when I own that protected put. Because if the stock goes all the way down to 140, I can take that stock and I can put it to somebody or I can put it to the seller of that option contract at 145 overall. All right, stick with me here. I'm a little bit long-winded, but if you do not like the concept of paying so much for insurance, well, then you just look at the collar trade. So we have the protective put in here. We're going to take that 155 strike and I'm just going to add it to our workbench down here. And now we're selling, giving away some opportunity on the upside, but using the proceeds to help buy some protection on the downside. Now, if we look at that, now we're talking about, let's call it 150, 35 cents. So now your total cost of your protection in this instance is about 35 cents overall on that collar. And, but I am giving up some opportunity on the upside. So if we actually scroll down, we look at the profit and loss calculator down here inside the Ally Invest option chains. We see, like, here's the position. You have 100 shares of Apple. You buy the protected put, the 145. You sell the call, the 155. And you basically are saying, I'll play between 145 and 155. And if the stock's not in that range, well, I'm going to take my ball and go home. On the downside, I know the most that I can lose. I can't lose anything below 145, but on the upside, I can't gain any more above the 155 level. So I'm talking about this in Apple because, once again, it's one of the more most widely held stocks within Ally Invest. But I also think about other stocks. You're coming to the end of the year. There's some stocks that you might want to take some profits on or some losses. Overall, you think about tax treatments in a taxable account, what I might want to do. I like using things like covered calls and protected puts to try to manipulate my portfolio a little bit as we come into the year end. So not only think about this if you have 100 shares of Apple or some other of the FANG stocks overall that have had all solid run-ups this year, but just think about your just portfolio in general and how you can use options to enhance that portfolio overall. All right. So with that said, I'm seeing a couple of things pop up in the chat box. Lindsey, do we have any questions? And by the way, if you have a question, Lindsey and I are going to be around for a few more minutes here. We'll try to address as many as we can. Just put them in the chat box and we'll answer as many as we can. All right, Lindsey.
Yeah, we've got some chatting going on in the chat box, which is great.
Are you there, Lindsey? I didn't hear that.
Actually, that's a great question. Why not just do a sell limit order for free buying a put, Brian?
As opposed to buying a put. That is a great question. Why not just put it would be a sell stop below the market, saying that if stock got to 145 at that point in time, I'd be willing to sell my Apple at the market. Now, the problem with that is you're not guaranteeing the price. If I put a sell stop in at 145, and Apple happens after this product launch comes out, happens to gap down more than 5 points. Let's say it gaps down 8 points. I'm going to get out 8 points lower. I'm going to get out at wherever the market is at. And now that's a downside of a stop, but it is an alternative. So it's definitely an alternative. Where with the put, I have the potential to say, yes, I want to exercise. I'm going to sell at 145. So you're setting the line in the sand with the put, as opposed to if you do the stop order in, you got to worry about gaps down in the underlying stock overall. Not to mention the fact that if the market did go down, I don't necessarily have to sell the stock. The put would go up in value, so I could just sell the put and remain long the stock. I would have a profit on the put, obviously, that I would have to deal with overall. But in general, that would be also, you're just be offsetting some of your losses as opposed to actually using the benefit inside the put where I can exercise and sell my stock at 145. So it's all about trade-offs, but that is a viable alternative to buying a put outright.
All right, great answer, Brian. Another question came through, or comment / question from Space Force Sergeant. Yeah, I wonder how hard the chip shortage is going to hit Apple. That's a good point. The company did say in their last earnings that they expected the chip supply constraints to be a bigger impact in the September quarter versus what they saw in the June quarter, which they did see an impact then. We haven't really heard them talk too much about the supply constraints. I think the auto industry has really taken center stage with regards to the semiconductor supply constraints is what I'm talking about here. It seems to be, as a lot of these semiconductor companies started to focusing on new cutting edge chips, that they dropped off some of the manufacturing of the older chips that need to be used in things like automobiles or industrial for industrial purposes, but also the older chips, some of them, these node type chips are what Apple uses, and that's older technology too. So that's what's impacting Apple. It will be interesting to hear if they talk about that at all today. I mean, really, they're going to focus on the product launch. We'll probably most likely not hear anything on that until they report earnings. I don't know if Brian, you have anything you want to add there?
No, overall, you covered it well, just in general. But yeah, the chip shortage is something that you got to think about. Apple did come out with a new chip, by the way, the M1 chip, which they've been touting in all of their MacBooks, et cetera, et cetera. But overall, the chip shortage is no joke. Obviously, the chip stocks have benefited from it. They've done very well. NVIDIA is a good example of that. But that is something that is a concern, but that's a concern for almost all industries overall.
Totally. One last question. We're going to try and squeeze it in for JHL here. He doesn't own Apple, or she doesn't own Apple, but is it a good time to sell a put to get in, Brian? What do you think?
Well, there you go. That actually is a real good point. That I covered 3 strategies, but yeah, if you don't own Apple, maybe selling something down around with a 140 strike, right around in that range, saying that you would not mind buying 100 shares at 140. That would be a viable thing to do. You could go out 17 days or even more. If you obviously, the further you go out, the more premium that you bring in. Now, the question is, would you be doing it on a cash secured basis? That means that if I do it cash secured and I'm saying I'll buy it at 140, that I have to have $14,000 in my account to be able to buy 100 shares at that level. But this is just an interesting time. We still got inflated volatilities. You're still receiving a decent amount of premium. We have the product launch today, but earnings aren't until November. So yeah, not a bad time to do that. It's just the same reason why I don't want to sell a covered call around earnings. Capping my upside is a reason why I wouldn't want to sell a put around earnings, saying that I'll take in the extra premium, but added risk of that earnings. So this is a good time in the quarter to look at selling puts if you'd like to buy Apple. Now that's totally up to you. Or selling calls if you already own Apple to try to bring in some income above and beyond any dividends overall.
All right, Brian, that's going to do it for this show of Stock Play of the Day. You'll be back on Friday at noon on the Ally YouTube channel to review this trade, especially depending on what we see happen in the stock after the event today and over the next couple days. So everybody be sure to tune in for that again at the Ally channel right here at noon on Friday. But that's all we got, Brian, right?
Right. So just click subscribe, ring the bell, and you get all the reminders for all of the stock plays of the day. See you this Friday.